Recording in progress.
All right, good morning, everybody. So, like we usually do, we want to start with finance juice, kind of take a look around at what's happening around the world, make sure that in the overnight hours nothing crazy or extreme happened that may bleed through into our trading day. It's also an opportunity to see what did well last night. Asia's already closed. It's around 12:45 in the afternoon in London. You usually get a pretty good market wrap on London, even though Europe technically is still open. They give us a little nod or a bump. They don't wait for the market to close for Europe to give us a market wrap. The euro dollar is back above parity, and U.S. dollar Japan continues to fade off. Bank of Japan yesterday, maybe it was the day before, made a statement that they weren't going to tolerate above 145, and so far that's sticking. And then U.S. China has continued to fade off. The auctions yesterday at 11 o'clock were an absolute game changer. If you go and look at what happened to the S&P, what time we reversed yesterday. We do have some Fed speakers today. We got Evans at 10, and we have U.S. wholesale inventories, and then Waller at 2. Inventories tell us a lot about how companies are doing. I remember a while back, it had not yet become the thing that everybody was talking about, say with Walmart and others who, kind of swung the pendulum too far and over ordered like crazy because there was a period of time where they couldn't get their hands on anything. And now they're oversupplied like crazy. But there was a period of time before everybody was talking about that where I had said, start listening for this sentence. You're gonna want to start paying attention to it. And within a month, it was, Kathy Woods was talking about it, and 9 o'clock today for these wholesale inventories. There is a rig count at 1 o'clock, but I worked on those rigs for 20 years, and the number really normally doesn't change that much. It's going to be, 3 rigs more or less added or taken off. There has been periods of time where we've seen, 100 rigs hit the dirt all at once or come online, but that's rare occurrences, not anticipated, not expected today. All right, volume's a little light, nothing extreme. Like I mentioned the other day, when you see really light volume like this, you really got to kind of ask the question, what are they waiting on? What are they waiting for? We just looked at the econ. There's nothing really on deck. So why the light volume, right? And that's always a question that should come to your mind when the kind of volume that we're looking at is comparable to holiday volume. Now, it's not crazy low, so I'm not going to dig too deep into it, but if it was less than 50, I'd be a little concerned. It's a quick glance. We turn it off when we don't need it. We have broken out of that range. It's kind of easier to discuss when we take it out to a higher time frame. Been sitting down in this box. And we're still looking for that clearance break to deal with this candle here. Now overhead we still do have this cyan line. That is the year-to-date anchored VWAP. So that's over our head, needs to be resolved. And moving averages. Two things with this. One, when it comes to moving averages, how far away from the 10-week are we? We are basically flat. We are there. We're going to be interacting with the 10-period weekly moving average right now. That one's real important. You're going to want to mark that on your chart. And then the 10-day. Now, from a swing trade perspective, that 10-week, if we're flat right there at the 10-week and we're crossing above it, 10-week crossover is a trigger for a long play, and you can think about it like the center of the basketball court. Plenty of movement to be made from either side. Looking at the 10-day, we crossed through it yesterday, managed to expand beyond it. We're barely extended beyond it at this point. So we don't need to look at that one as having moved too far yet. Again, very close to the center of the court. Plenty of movement to be had on either side. We're not overextended or anything like that. We had a 410 crossover yesterday. That's a moving average pair called the surge. Now the 4 still needs to cross above the 10 for the surge to be complete. But the fact that we had price cross through the 4 and the 10, that is the beginning of this surge. It looks like it's going to complete either today or Monday. And then we'll also be dealing with this green moving average, which is a 20. When it comes to moving average groupings or moving average pairings, 410, 1020, 2050, 5200. Surge, momentum, trend, strength. And within those 4 groupings, has price crossed the group yet? Has the group separated itself from low to high, like the 4 being above the 10 or the 10 being above the 20 being above the 50? And then how far away from the moving average pair is price? And every one of those are a part of a metric that you can use, say ROC and rate of change, or something like MACD and histogram bars. a default MACD would be 1226, but if you're quantifying how far away two moving averages are, which is what MACD does, you could put two moving averages in there that you want. We did have a 50 period moving average cross. There's still another 50 over our head. It depends on if you're looking at an EMA or an SMA. We've got both plotted here. So over our head, the resistance that we have is a 20 and a 50. And we are interacting with a 50 today, currently. So it's definitely worth putting these higher time frame moving averages on your chart. Because if we come into contact with these moving averages, there's very likely going to be a reaction in the market. I just swapped to a week, and you can see that we hit the 4 period weekly moving average this week, and that the 10 is right over our head. So is the 20. So if we are going to make a new leg up next week, we've got to deal with that 10 and 20, maybe even the 50. Speaking of leg up, keep in mind the swing high and swing low. Now we could get shunted here and fail to come all the way down, just like it happened here, right? You had a swing high, drop down, start the process for a new swing high, gets blocked, doesn't make it through, sets a new low. Well, the same thing can happen the other way around. You get a leg up, set your level, expect the reciprocation, but it doesn't make it through, and end up getting a new high. It would look a bit like that if we were to flip everything over, right? So with that in mind, one of the benchmarks that we're going to want to keep track of is that 4020. It's the high from Friday last week. A little bit of a line in the sand. We need to keep that now that we're out of it, but we very well could get a bit of a Busby if that is considered our resistance and we finally break through resistance. Price has a habit of validating old resistance as new support. And that's all that a Busby is, rather than having to say that entire sentence. Old resistance becomes new support. That's a mouthful. You know, if you can just say Busby, it'd be a lot easier. So we could get a bit of a pullback to that 420 area to validate that old resistance. We've already moved half of our ADR, and we are currently in a market maker move condition. This is a think or swim concept. They invented it. Maybe they didn't invent it, right, of what it's measuring, but they certainly invented the name. And all it's doing is looking at the front series and comparing that to the back series. And if the front series is bigger than the back series, then they measure that distance between the two, and they call it market maker move. Generally speaking, it happens when there's an event like earnings, but it also happens when the front side just gets priced in a bunch of volatility for some reason. Say Powell's going to talk, or something like that. If the front end gets a higher volatility than the back end, you're going to get a market maker move. That's it. If If you want to learn more about it, though, and there is a lot more to learn about it, you can go to the Ticker Tape, which is a publication of TD Ameritrade. It's free. You just Google Ticker Tape TD Ameritrade, you'll find it. Search for Market Maker Move. They've got all kinds of really great articles that dumb it down and put it into plain English, right, without using all the fancy bank speak. I'm not saying y'all are a bunch of dummies, but those dummy series, they just take things and put it into plain English. You gotta love it, right? Maybe they could have named it something a little bit better and not call us a bunch of dummies, but it don't hurt my feelings. So if you take that market maker move, which is 0.5%, and you add it to the ADR, which is 1.5%, well, it's really 1 3/4, but we're going to do a little rounding math. So 1.5 and a half, that's 2. That's a 2% move on the day. This market, the ES, could make a 2% move today, and it wouldn't be considered extreme at all. It could move 4% today, and it would just begin to touch the boundaries of what would be considered extreme. Now, I'm not suggesting we're going to make a 4% move today. If you go back and look throughout history, it's very rare for the S&P to make a 4% move. I don't think today's one of those days. The ADR half is 40.46. The ADR full is 40.82. And the previous week's high is 40.72. Now that's a benchmark that you really want to be thinking about today. Can we get above last week's high? There's a lot of reasons that we would want that. When it comes to technical analysis, counting pivot points, where we close, where we open, pullbacks, all of that is all really important. That's a benchmark that I would be looking for today if we turn bullish. Getting completely outside of last week's price action. And so far, I mean, we've done a really good job this week of just staying inside the lines. We do have the 50% retracement. That one's right over our head. That would be at 40.50. So from this pullback, we'd need to break Globex high at 44, the ADR half at 46. Then we got 40.50, 40.72, and then 40.82. Now it's a wide gulf between where we are and this market ADR way up here at 82. It's about 50 points away. That's about a 1% move from our current location. So the market stalled with that 2-bar reversal or tweezer top, whatever you want to call it, 40.31, 40.43. The warning center, we failed to make it through. If we do get up and clear through that ADR half, we'll be at the 1236. The reason I did that is so that we can start lining up some pivots, since it's such a big distance between where we're at and a full ADR, that it would help to have some pivots along the way. All right, well, that gave us a little bit more. Now, each one of those would be like a benchmark, right? We get to that distance, reevaluate. Keep in mind that every one of those red lines, those are warning centers. So those are places where we expect the price would get stuck and stall and begin to fail out, just like it did down at 40.43, right, in the lower portion here. It made it to the red zone. It couldn't get through there, stalled and pulled back. So 51, 61, 75, those are zones where we expect price to get tangled, maybe stall, and just fail to complete the move up to the next level. Once we get to that next level, every blue spot is where you're going to anticipate opposite candle color or doji. So price would get to that level, pause there, consolidate, give us that opposite candle. Depending on the chart time frame that you're on, we're on a 15 here, that process could take quite a while. Dial that down into a smaller time frame, you'd have to redraw a lot of these levels, but it'd be the same process. 1, 2, 3, 6 is the target zones. The 111s are the warning centers. So I'd say that divergence stands out pretty good, right? Where we had this area here. But we're already done with that area. And now what we really need to focus on is more in this area here. And while the market had that nice little pop, we're not seeing that same sentiment here. It could have a lot to do with the same issue that's causing the low volume this morning. It'd be worth maybe looking into that a little more. Ask some questions about the volume. When it comes to volumes, sometimes it's something very simple. Are all of the markets open? Right? So, say the Queen died yesterday. Did the London markets open? Is the European markets open? It could be something just as simple as that. It doesn't always have to be, that there's some kind of econ or some kind of event. Low volume could just be because there's a holiday or a nation in mourning, right? Something like that. Keep those lockdowns in Asia in mind. There was some numbers that came out last night for China, and their GDP was revisions were just absolutely horrible. And yesterday there was revised European GDP numbers that were a shocking. Just absolutely surprised the market didn't blow up on that yesterday. And it was like calm waters run deep situation. Nothing happened. When I was looking at the S&P 100 this morning, I was kind of trying to take a look around what was moving and by how much. Technology services, it's the FANG names, right? It's the monsters of tech. Uh, Google, Netflix, Facebook, Microsoft, Nvidia, Apple. And sure, I mean there's other names too, but it was the monsters of tech that got my attention first thing this morning. So here what we're looking at is a simple question. How many names in the S&P 100 are up at least 1%? 23. Well, since it's 100 names, you can turn that into a percentage when you speak, right? So it's not 23 names are up this morning in the S&P, it's 23% of the S&P is up this morning, at least 1%. That puts some context behind it. Now 23 is not that bad. It's not even that great. Like, we're not all bulled up looking for a market move yet. But you're going to want to revisit this number as we get closer to the open. Then when you're looking at this and it says, okay, 23 names are up 1% or more this morning, what industry, sub-industry, and group do they belong to? Are they representing anything in particular? Because if it's all a bunch of trash and meme names, well, I don't care. That's not going to inspire me to want to look for opportunity. So we got Google, Salesforce, Adobe, Microsoft, Amazon. And then we've got some odd ones like Caterpillar and energy. We were going through this energy rotation the other day, well, the other week, where we were rotating out of energy and into, it should have been, into tech. But we didn't go into tech, and we ended up getting a bunch of volatility instead. Well, if we're now finally starting to move into tech, why are we seeing energy names up again? Now, it doesn't have to be an either or, right? We can see both going down, we can see both going up. The thing is, if we don't get that kind of rotation, we're going to get volatility. It's got to be, right? It's got to be one or the other. You either get the capital rotation that you're supposed to get, or you get volatility. And one thing we really haven't had a lot of is volatility. All right, we got the dollar below 110. I keep in my mind hearing like a stadium applaud every time I say that. We're below the 110 again. Yeah. Crazy, right? 110 is a big benchmark, and I've heard some really smart people calling for 120, 125, 130. That's some crazy levels, and it is going to have global implications. But of course, it's not a straight line. We hit a multi-decade level at the 110, and we pulled back. So it's not much of a surprise. It's a line that's been on the charts forever. But we've had a substantial move in the last 2 hours. We want to see that slow down. This needs to remain calm. You can see how as the dollar begins this rip back up, NASDAQ coming back to VWAP, S&P coming back to VWAP. So this is a direct inverse correlated product, and it is an albatross. It's a weight around the neck of our marketplace right now. It's not always this way, right? You wouldn't want to go out and like forever and ever benchmark a dollar moving in the opposite direction of the market. But that's the way things are right now. It's been that way for a good 6 weeks. It's going to continue to be that way for a while. So watch the dollar constantly. It's one of the best indicators you could put on your chart. I think the only indicator that I have right now that's more powerful than the dollar is the clock. It's taking bonds with it. We got stock and bonds moving in the same direction. Bitcoin kind of shrugged it off a little bit, and that was a really healthy move. I shouldn't say it that way. It was a really expansive move in Bitcoin. There's certainly nothing healthy about a market going parabolic like that. I would be looking to flip that thing right back on its head. Things that are up the most have the most room to fall, right? And that thing is up 9% this morning. But I wouldn't short it just because it's up 9%, right? Like a market, there's no such thing as gone too far when it comes to exuberance, greed, and fear. So a line in the sand, benchmark, 25.20 in the VIX. Below that is market bullish. Above that is market bearish. We are below that. Another line in the sand was the 23.5, and we are below that as well. So looking at the VIX, looking at the dollar that's faded off, we're in a risk-on sentiment. We should see this market continue to rally up. But it won't take much to flip it back over again. We start seeing an aggressive rise in the dollar, start seeing that VIX get back above 23.5, definitely above 25.5 or 25 and a quarter. Could stall this market out and dump it right on its head. I think one of the bellwethers, when you go out to the airport and they have those wind socks floating in the breeze to tell pilots which direction the wind is blowing. A really good wind sock right now is that Bitcoin. Remember, we don't use this for any kind of parity or correlation. We're only looking for global speculators who have enough money in their pocket that they want to go out and gamble and take risk. And Bitcoin is the purest form of risk that you can put your hands on right now, other than going to Vegas and rolling a set of dice. So when we see Bitcoin bid up, it's like a sentiment gauge for risk, for speculation. So we got our benchmarks, we got our lines in the sand for the day. The Nasdaq and the S&P need to maintain above VWAP. If they break VWAP, for the ES, it's back to the COG line at 41.11. That's the high of yesterday, by the way. It's not a coincidence. It's where we stalled. So 41.11, the high of yesterday, that's an inside day breakout. Before that happens, there's the high at 40.20 from last Friday. So, when you fall from the top of the tree and you hit every branch on the way down, it's all those pivot points below us. Nasdaq, same thing. Break the VWAP, retest yesterday's high, and you got a roundy at 12.4. Bellwether to keep your eye on, the VIX and the dollar. The bonds aren't really going to give you much insight. They're basically moving like stocks are moving. If you were going to watch the bonds, look for this correlated coefficient to break apart. Right now we're in parity. Stocks are moving down and bonds are moving down. Stocks were moving up and bonds were moving up. Bonds were moving cleaner, but still they were moving up. Look for this duo dynamic to break. For, say, the S&P and the Nasdaq to break VWAP and continue to fall, and bonds continue to rise, or vice versa. That would be a tell. And then VIX with those two levels would be a tell. The dollar back above, it's an inside day breakout right now, so getting back above yesterday's low would be a good start. and then challenging that cyan line at 109.60. That's the 4-period moving average. Speaking of moving averages, all those daily moving averages that we were talking about, Thinkorswim offers you an opportunity to plot daily moving averages or even weekly moving averages on your intraday chart. Just type in the word daily and you'll see you get a list of indicators. So daily simple moving average. Once you open it up, you can change it really to whatever you want, as long as it's a higher chart than what you're on. So if you're on a 15, you can't put a 2 on there, or a 5 or something like that. It has to be higher than your chart. And you can build these into a group. That way you don't have to go in and do it every single time. It's already done. So yesterday we came into contact with the 10, and that really just kind of shut us down. And the 4 was holding as a support zone. In the overnight hours, it's been the 50. And right now, we've got the 20 overhead and the 10 and the 4 underneath us. Looking at weekly time frame, 4 and 10 are above us, 20 are below us. Now, I don't really use moving averages as some sort of trigger to get in or get out of a market, but I definitely use them to gauge where the market could go and where we're likely to bump our head. Constantly asking a question, are we moving towards one of these levels, or are we moving away from one of these levels? Now, when it comes to the 50 and the 200, I've kind of got into the habit of looking at both. I used to try to pick one or pick the other, but the bias is just too strong. There's a lot of traders who will live and die by that SMA, and they don't care. That's what they're going to look at. And then there's the same diehard group on the EMAs, and they just won't leave that position. And both sides, the group is so big that it doesn't do you any good trying to pick one group or the other to see what's going on out there. You're better off just putting both of them on the chart and looking at both of them. Now, I don't do that on every single moving average. The 20, the 10, the 4, I don't do that on all of them. But the 50 and the 200, I do. One of the things you can do to make that easier for yourself is turn one of them into a dotted line. Just change the line type. To me, a 50 line is orange. So they're both going to be orange. But if you change one of the line types, say the SMAs to a like a dashed line, and then it's orange, you would know, okay, well that's a 50-period moving average, and it's the SMA because it's dashed. It takes a little while to train your brain to do that kind of thinking, but after a little while, a few weeks of looking at the same thing every day, it will become just a normal instinct. You won't even think about it. Like, yeah, that's the SMA or that's the EMA. So when I turn on the other 50, you can see that we're kind of getting pinched between the two. Now, a lot of times, both of those 50s are going to be in the same place at the same time. They're not always different numbers. But during periods of volatility, they'll spread out quite a bit. If we make a move to the upside today, that 50 EMA is in play. So you're definitely going to want to know where that one is. And we're resting on the 50 SMA. Look for a high correlation coefficient today with rotation in energy and tech both moving up. We could see something like an 85, 95, 97 correlated coefficient. One of the easiest ways to do that, just go to Market Watch, visualize, pick your index. Well, when it comes to the index, first you can detach these things. Make them all nice and small. Pin it so it doesn't fall behind anything. And then pick your indexes like the S&P 100. This is basically an advanced decline line, but it's a more detailed advanced decline line. It shows you where the money is. You know, they always say, follow the money, follow the money, follow the money. Okay, so follow the money. And as you can see, it doesn't take up a lot of space. And by the way, you can do that with any watch list. So if you make a watch list of the monsters of tech, for an example, you can watch the money flow in there or on any sector, industry, sub-industry, however you want to do it. Three sectors for risk on: finance, technology, and consumer discretionary. When you break those down and you look at them by their greatest market cap weight, the names that are in there, it always comes back to the monsters of tech. If we get that high correlation coefficient today, then we're going to be looking for, say, 8 of the 11 sectors in the green, 95 to 97 names out of 100 all doing the same thing. And with very little econ on deck, we have the capacity today to make some serious moves. Next week is OPEX, so keep that in mind. It's the third Friday of the month. And the last gamma flip level, if I remember right, is like 40. There it is, 4042. It might not be that number now, but that was the last one that I picked up. All right, everybody, that's what I got. Have a good weekend. Be careful, be safe, and I will see you all next week.
Recording